Good morning, everyone. Happy New Year, and thank you for joining us for the latest edition of TAM Talks, which is aptly titled 2020 Hindsight and Tomorrow's Outlook. Before we begin, I'd like to go over some housekeeping. Below the presentation, you will see various tabs. First of which is attachments. Now, under the attachments tab, you'll be able to see a copy of today's slides, which you're able to keep for your records, along with our ESG questionnaire, which I'll go into a little bit more detail in a minute. There's a questions tab. This is where you can send questions over at any time during the presentation, which will be answered by our speakers in a dedicated Q&A session at the end. Finally, we have a Rate This tab. You can rate today's webinar. It obviously helps us a lot if you do this, helps us to tailor future presentations, make sure that they're relevant for you in the future. Before we begin, I would actually like to take this opportunity to indulge myself a little bit and give a brief overview of TAM and touch upon some of the changes we've made over the past 12 months. And for those of you who are not too familiar with us, TAM is a DFM with a global footprint, boasting UK, European and international based operations, which ensures we're able to service a wide range of clients regardless of domicile. As well as offering appropriate currency options to reflect these operations, we also have a diverse range of portfolios available, ranging from Premier, which are active mainstream investments, ESG, which are a blended approach of ESG, SRI and ethical solutions, Sharia, which are specialist religious ethical suite, and finally passive, which are low-cost actively managed passive accounts. It's important to note that each of these portfolios has at least 5 risk levels available to clients, that they never have to sacrifice risk suitability in order to achieve a preferred investment style. Just to take you into what we're doing, what we've done on the distribution side, and how we're trying to help you guys moving forward. 2020 was challenging for the most part. It did prove to be an opportunity, however, for TAM to take stock and strengthen our distribution capabilities. But we were able to further our partnership with Simply Biz Group to include Compliance First members. We also took part in ESG-focused presentations to over 300 financial advisors in Q4. We've worked with Financial Express to make our Premier and ESG portfolios available via their analytics system, so you can scrutinise our portfolios against our peers. It's worth mentioning that we are also in the process of bringing our Sharia portfolios on board with this as well. In Q2, we became a platinum partner with the Federation of European Independent Financial Advisors, or FIFA, as they're more commonly known. We're working closely with FIFA to develop relevant content for their member base over the coming years. And all throughout last year, we worked incredibly closely with De Facto in order to rate our Premier and ESG portfolios in terms of risk, as well as our overall proposition. Our portfolios are now fully researched on De Facto Engage for those of you that use the system. And I'm pleased to say that we were awarded a 5-star rating for 2020, and that has officially been extended into 2021. All of these things have been done to make your life easier when recommending our products to your clients. We'll of course continue to engage with the advice community in the years to come to ensure our proposition is as attractive as possible, but this needs to come from discussion between ourselves and yourselves. With that being said, I should also mention how we've bolstered our direct offering to help meet your MiFID requirements. Not only do we offer instantaneous quarterly and annual MiFID reports via our direct platform, but we also produce and send tailored 10% letters in the unfortunate event that these are needed. The best thing about these 10% letters is they're not just a standard letter that can leave clients concerned and with more questions than answers, but they include reasons why the fall has occurred, reactionary portfolio positioning that the investment team has made, along with market outlook. This, coupled with the excellent reporting capabilities that TAM has become known for over the years, has been met with praise from existing users, and I'm sure will be well received by new connections. We've also created an ESG-based questionnaire to help meet impending directive change in Q2 of this year. This is a generic spin-free document which is intended to help table the ESG conversation between you and your clients, as well as help you fulfill your regulatory obligations. A copy of this questionnaire can be found in the attachments tab below today's presentation, as I alluded to earlier. The final thing that I wanted to mention is that aside from our direct offering, We've also made our Premier and ESG portfolios available via a wide range of third-party platforms, the newest of which are Eccentric, Embark, and Standard Life. Again, this is in response to advisor demand, where we've engaged and recognised that we need to be able to fit your processes wherever necessary to ensure the best outcomes for your clients. So, 2020 hindsight and tomorrow's outlook. I'm pleased to say that there's a slight change to the advertised agenda. We'll be joined this morning by both TAM CEO, Lester Petch, and CIO, James Penny, who will recap the year that was, as well as look forward to the year ahead and how TAM is positioning its portfolios. James, I'll leave it over to you.
Thank you very much, Joe. Ladies and gentlemen, thank you very much for dialing on today. Usually it's up to me to do these presentations. I really enjoy them. I think what we've got, which is quite special today, is Lester Petch joining us. I asked Lester to join us today because he brings a huge amount of experience to not only TAM's investment team and TAM in general, but to the narrative about 2020 and 2021. Lester's got a huge amount of experience in previous market cycles, and that experience is so critical to understanding and navigating future markets. And not only that, but looking at the makeup of 2020 and what this crash looked like. So Lester and I are going to be talking about the markets and talking about where we think things are going in the future. What I wanted to bring to you first was one of the major developments that we've been able to implement in the portfolios in 2020. It's been a 2-year process, and that is basically a huge cost saving that we're delivering to our end clients, and that is the concept of OCS. That's the concept of every single fund that TAM invests into obviously has an ongoing charge that we pay. Now, TAM considers itself to be a very active portfolio. We take an active position for our clients. We think that's critical, especially in this type of market. Now, usually you pay about 75 to 80 bips, so that's 0.8% to the manager for them running the sleeves of your portfolio, if you will. So what we've been able to do and what we've been driving towards is reducing the cost of that portfolio to our end clients. Now, 2 years ago, the OCFs of the portfolio, so that's all of the charges of the underlying managers, that's the commission that they charge to run the money, was looking at about 0.75%, so 0.75. What we've been able to do as of January 2021 is we've been able to reduce that to 0.39. That's nearly a 50% reduction over 2 years. Now, we don't take any of that. That's completely, that's got nothing to do with TAM. That goes straight onto the end client portfolio. So we've been able to nearly make a 50% reduction to the charges that clients are paying on this portfolio, which we think is really powerful. And I believe that is the direction of travel for this market. I think everything is becoming more efficient, it's becoming more active, and more importantly, it's becoming cheaper. And what TAM wants to do is make sure that we're at the forefront of that. What I'm going to do now is get into the presentation and start to review the year. Just very quickly go over markets, what 2020 looked like, the winners, the losers, and more importantly, what this looks like for 2021.
Hi, James. This is Lester.
Sorry.
I'd just like to jump in and ask you, James, a question during this, actually, which is, it's very well cutting those prices, but, give us a bit of a flavour of how you managed to do that.
Sure, absolutely. So, for the listeners, Lester and I are just going to jump in with one another. We're just going to have a conversation that we hope you can glean as much information from as you can. That question that Lester was talking about the underlying OCFs, it's not as easy as being able to just reduce an OCF. You go to a fund and you say, right, your fund is charged 75 bips. I would like to pay 20 bips. And the fund will obviously say, no, the charge is the charge. That's what you pay. That's the experience of the investment manager. That's the experience of the fund manager. We won't charge less. So the way that we've been able to do this, the way that we've been able to achieve this 50% reduction is TAM is, I think, maybe one of 3 or 4 DFMs in the market that is at a certain place in its size that's very attractive to fund houses. Let me explain. Fund houses, when they launch a new share class, when they launch a new fund, they look to offer a fee deal. They look to offer an attractively priced share class of that fund for new investors. But it can only be to an investor of a certain size, because if you imagine, they can't go to Schroders and say, okay, Schroders, I would like you to be the initial investor on my new fund. Schroders will come back with their size and they'll go, okay, that's fine. My minimum investment is 250 million. Obviously, the new fund house doesn't need 250 million. What they do need are smaller incremental clips of 10 million, 5 million, and 15 million. TAM is one of the few investors in the marketplace that has the ability to put that level of capital into a new fund. Now, obviously, we don't put our money into any fund. We make sure that we've researched the fund managers. We make sure we've researched the fund houses that we're investing into. We make sure that there's maximum security. As long as if we are taking a position in a new fund and we're the first investor, we need to make sure that there's maximum security within that fund. So we never take a fee deal. We never join a fund house on a new venture unless we are as certain as we can be that this is as secure as possible. So what we've managed to produce is we've managed to fund and seed some of these new offerings in the market, which personally I believe are going to be some of the biggest funds in the future. For instance, TAM is a seed investor on one of the new BlackRock global funds. Now that's BlackRock, that's the biggest asset manager in the world. We were perfectly happy to be the first investor through the door, and we were rewarded for that. Now I say we were rewarded for that, our clients were rewarded for that, because TAM makes no money on a cheaper share class. It all goes back to the underlying client. So that's our ability, that's our space in the market. We're really capitalizing on it. Just one more thing. When we go in on these share classes, when we see these share classes, we have them forever. It's not like in 3 years' time, the OCF goes back up or the charges number goes back up to the original number. We have pricing in perpetuity for our clients, which means that new clients can take advantage of that as well, not just old clients. So we're building for the future here, which we think is really powerful.
I think also it's worth noting that these are new share classes of existing products for the most part. This isn't new funds created out of an idea. In fact, some of the work that James has been doing has been the opening up of institutional style share classes of existing product with major houses that have long track records of doing exactly the same thing. So quite often this isn't like seeding a new fund with an idea. This is about seeding a new share class of an existing fund that's got a strong history and track record. That's fair, James?
Very fair, very fair. What I would finally tack on is that we don't just use our expertise in working with funds to produce products. We don't just use that for the advantage of OCS and pricing. In the Sharia market, where there is a huge, there's still a lack of products for Sharia investors. We believe we have one of, if not the best Sharia portfolio in the market today in the DFM world. But what we do is we work with fund houses and we work with ETF providers to tell them what our clients are looking for. What do our clients want in the Sharia market? And these ETF and fund houses are really listening to us, and they start to generate and create products tailored not only to the market, but to TAM's clients. And then we can be the first investor on that. It's really powerful. I'm very excited. I think there's a huge amount of appetite in the market for new products, especially within the ESG and Sharia environment. And TAM is really privileged to be able to be on the forefront of helping fund houses design and create new products, which I think is groundbreaking. And again, not many DFMs do that. Many DFMs just stay with the big share classes, doesn't matter about OCS, just to create those portfolios. So I think we're offering something new there, something different. Lester, shall I get into the presentation? Should we get in and talk about 2020, you and I?
Let's go for it.
Right. So I'm going to go forward. So what we wanted to do first was talk about what was different about 2020. Now, for me, being an investment manager, I'm early in my career. 2020 for me was a watershed moment. I had not experienced anything like it. So what I wanted to do is, in terms of talking about 2020 and the dynamics of the market, I wanted to put this over to Lester and ask, what do you think, Lester, was different about 2020 in your experience of previous market crashes? Do you think it was the same? Do you think it was different? What were the metrics that you were seeing?
I think it's very interesting. I mean, unfortunately, I've probably been through about 4 of these. It might be 5 if we include 2020 as a crash. And actually, they're never the same. There's always a different reason, a different dynamic, a different metric that makes things happen. But the end result is always the same for us poor investors, and that is we get a hell of a hammering at one point. Then it's a question of when you have the strength of mind or the capability to re-enter that after big falls. And I think one of the things that we've done during 2020 is to stay calm and to stay with what was going on, because I have to say in 2020 there were 4 distinct parts to 2020 from an investment perspective. And I know you probably think you can see 2, but in genuine, honestly, there was 4. You had the January-February period, which was, pre-COVID, which was more like a normal operating environment. Everybody was getting on with their lives for the most part. Then we hit the demise of the markets late February, March, and into April. And what actually happened is we had the huge rise of the stay-at-home stocks. The rise of the tech, the rise of anything that was a major beneficiary of being locked in your home and work, and these were well known to us all. So we had this period where markets were lower, but stay-at-home stocks did extremely well. The trouble is the stay-at-home stocks are sort of quite few and quite far between. So you had massive differences and divergences in performance of product, because you had the sort of very high-tech deliverable work-from-home stocks going up while the rest of the world was in free fall, or at least they weren't going down too far early on, and they rallied quite quickly. Now, interestingly, that went on for some months, and I think when we all look back, we all know which stocks they were. So, I mean, James is going to move on to what were the ups and what were the downs, and it was pretty obvious who the winners were earlier in the year. And in fact, people began to believe that was the only game forever, or the only game in town for now. And the only game in town for now was actually stunningly outperforming for something like up to 6 months. What actually then happened is, and it only happened as a result of maybe we have a vaccine, going back to the October-November period, is there was a rapid and unprecedented transition to what we call the, emerging from pandemic stocks. I don't like to use the word value, because what we had at that time was anything that had absolutely been distraught during the February to September period rallied astronomically. We had stocks and shares that had been negative all year rallying 30, 40, 50% within a month. And at the same time, those stay-at-home stocks reversed. So you had this bizarre situation where you either made so much money by being invested in the right things for the first 6 or 7 months of the year, and then basically the market goes up 10 or 15% and you don't make any money because you're in those things that were guiding you through the pandemic. So, towards the end of the year, and I'd say the fourth quarter in its entirety, if you want to put dates on it, we had this emergence from the pandemic type market where we were seeing things going up that you'd say, well, why would you buy airlines? Well, why would you buy, entertainment industry? Why would you buy UK-related domestic stocks? Well, what's the interest in those? It's not here. Well, my experience over this sort of 40 years now, unfortunately, is that markets do tend to discount quite a lot in advance. They're a discounting mechanism in themselves. And they're thinking about what might happen in the second, third quarter of this year. Now, what I found at that time was everybody telling me it was a blip. These stocks, the emerging from pandemic stocks, I call them, it's only temporary because all of these growth and stay-at-home stocks were going to continue to run and run and run. Now, I am not against these stay-at-home stocks. I think they've all got a good part to play in the global economy as we come out of this. But we are not going to be as reliant on these household names that we were in 2020 into 2021. It's just not going to happen. That's the third leg of this four-part 2020. The bit you're missing is what I call the segue in the middle between the stay-at-home stocks being the darlings of the market to this disbelief in the emerging from pandemic stocks, which is still going on, to be honest. There was a bit in the middle where the attention for the market was firmly tracted onto the precious metals market and the metals and the commodities themselves. And so during the summer months, we had unbelievable, defensive-minded rallies in gold, platinum, silver, even some of the more staid and boring commodities were rallying really hard. And that was a sort of bit of a segue into this emergence from pandemic, because these things started to behave more like they should do. So we had this like fourfold 2020, which is going to be rolling through into 2021 in a completely different environment. So I think it's better to look at, what we knew were the winners. So James, if you want to move on and make comment about those winners and the losers.
From my end on this year, I think one of the things that's been starkest for me has been the huge divergence, the bifurcation between what's been coined as Wall Street versus Main Street, which is the global economy and the job losses and the deaths, the unemployment, all of this, the real blood on the street in people's everyday lives versus the stock market that finished on all-time highs, that carried on rallying and rallying and rallying, seemed to be impervious to all of the, troubles going around on mainstream. And I think that was on Main Street. And I think that was, for me, one of the largest and most notable things to watch out for 2020 was that bifurcation. And I think that's something that feeds into 2021 is how does that dynamic change? Does it carry on? As Lester's alluded to, let's get into who won and who lost, and let's just understand a little bit more about exactly what Lester was referring to. To my mind, who won and who lost, it very much depends on what side of the coin you were on. And what side of the coin you were on largely depends on what part of the year that you're referring to. So in this instance, let's refer to the first half of the year. What we're looking at here is the winners of the first half of the year, right? So that's very much the kind of coined by the FANG index, coined by Facebook, Amazon, Netflix, Google, essentially the stocks that were benefiting from staying home, right? Investors were flocking into high growth stocks. The belief that massive fiscal stimulus and the recurrent message that that we're lower for longer, central banks dropping interest rates, it gave basically, to my mind, everlasting credence to these huge growth targets that these companies were putting on. And investors just kept buying them and kept buying them and kept buying them. And the fact that the central banks kept pumping liquidity into the market and they kept reinforcing the message that they're not going to raise interest rates, it basically kept investors pedal to the metal, as it were. It kept people buying. It kept people with conviction into these stocks. But you didn't only have these. You had the likes of Dell. Dell saw a massive appreciation in its share price as people started to buy home offices. They started to buy computers. They started to upgrade their printers. They started to do everything like that. You saw IKEA. You saw Homebase as home improvement stocks started to come through. So there was that massive set of winners that were led by the FANG index. Now, if you go through into who lost, now that's pretty much obvious. I think every single one of us listening in, we could all talk about the winners and losers of the first half of the year. And obviously the losers off the back of that were banks, were airlines, were hospitality, bricks and mortar retail, anything essentially that involved you having to spend money outside of your home. That was essentially what was going wrong. That was essentially where the negativity was being priced in. Now, the thing that I find interesting about the first half of the year was that at the peak of the crisis in the first half of the year, banks, airlines, hospitality, brick and mortar retail. It was priced like COVID was never going to end. It was priced in the way that said to me and said to us at TAM that people believe that COVID was never going to end. These airlines were never going to recover. And Dell, Apple, Google, Netflix were priced in the same way that COVID was never going to end. And that obviously wasn't the case. You knew that there were vaccines coming through. You knew that these global governments were taking huge steps to mitigate mitigate the impact of the virus. So we knew it was going to end. And to us as investors at TAM, that spells an opportunity in the market. That spells a bifurcation which you can start to take advantage of. But again, that's the first half of the year. So these two slides that we've talked about are really geared towards the first 6 months, because as Lester referred to, in the second half of the year, we had this huge precious metals rally in the middle, which TAM was some 15 to 20% invested into for certain client accounts. We made record outperformance over that precious metals trade, which we are happy about. But what we're doing here is talking about the opportunity from that first 6 months. So just quickly, going back to who won and who lost. In the second half of the year, you had the announcement of vaccines. You had the summer months where people were coming out and spending a little bit more. You had manufacturing indexes recovering. You had employment numbers surprising on the upside. You had people starting to get a little bit more comfortable with the market, and you started to see airline stocks, hospitality stocks start to recover. But that was really supercharged in November when you saw the vaccine announcements come out. And in 4 trading days, just as an outlier, right? In 4 trading days, you had stocks just absolutely rocketing past one another. So you had, for instance, let's say Fundsmith. Everybody knows Fundsmith, Terry Smith's global fund. So he predominantly has been a growth investor. He's been a big champion of growth stocks. Pazina is a really high quality value fund that we own in the portfolios. And we started to initiate that value position in the second half of the year. In over just a matter of days, that value fund massively outperformed Fundsmith. I mean, there was a huge cyclical rotation in the market, which saw investors flock out of growth stocks into value stocks, into those stocks that were being hammered by COVID, those same stocks that were priced like COVID was going to continue forever. It's interesting, if you look at IAG, which is the owner of BA, versus Netflix, which to me is the very antithesis of stay at home, right? You're sitting on your sofa watching TV. In 4 trading days, BA and IAG rallied 44% and Netflix fell 4%. In 4 trading days. That's huge. And that's a massive, it brings me back to what side of the coin you're talking about. Because if you're looking at the second half of the year, the losers from the first half of the year were very much the winners of the second half of the year, especially in the last quarter. It was really quite dramatic. And what we're seeing now is that feeds into 2021. We're seeing a continuation of that. We're seeing a lot of the winners from the second half of the year, those reflation, the non-growth stocks, and I hesitate to use the word value stocks, but the value and the COVID-affected stocks are the ones that are carrying on. And you can see that outperformance of value versus growth continuing into January, which means that investors are still interested in that side of the coin. So what we'll do here is we'll talk about how this feeds into 2021. So what I'm going through here very quickly is essentially what are the factors that we believe are going to feed into 2021. What I've put here is the top left is people cheering. That's my version of GDP recovery. It's largely anticipated there's going to be a very, very quick reflation back to pre-COVID GDP growth. How are we going to do that? That's the picture on the top right. That's very much to do with spending. A lot of consumers have a lot of capital saved up. They have a lot of savings. They have a lot of money to put to work on consumer staples. They have a lot of money to put to work to going on holiday, flights. That tacks me into the bottom left, which is airlines. It's going to be a lot of people looking to go on holiday. I think everybody probably listening in can't wait to book their first holiday. So that's going to see a massive resurgence in flight numbers, in seat numbers. So you're going to see this recovery, right, which I believe is going to drive the market higher. At the very least, it's going to justify the expectations that people bought into 2020. So if you were buying stocks in 2020 because you believed that there was going to be a recovery in 2021, I believe that as an investor, you're going to get that recovery. The final one on the bottom right is the US versus China trade war. If you remember back to the days of 2018, when we had Trump very much ratcheting up rhetoric against China, against trade, what we can start to see with the Biden presidency is the potential for that to ease, is the potential for Joe Biden to say, you know what, we will keep some of the sanctions on China, but what we're going to do is we're going to walk back some of the trade problems. We're going to increase trade with China. Now, if you were an investor in 2018 that sold out of stocks because you were worried about trade concerns, it stands to reason that you're going to put money back into the market now that those trade concerns are going to be going away a little bit. That's something that we're keeping an eye out for. We believe that that's also going to push assets in towards Asian markets and emerging markets, because a lot of the sell-off in 2018 was to do with Asia stocks, was to do with emerging market stocks. So we believe there's going to be a reflation there. So 2021 is going to be a year of recovery. Now, it may not be, as I said earlier, you've got a divergence between Wall Street and Main Street. It may be that Wall Street is going to take a break and wait for the economic recovery to take hold before we can see another leg of rallying. But what's plain for me to see is if you believe that this recovery, a resurgence in spending, people going outside, people going on flights, you're going to start to see those COVID-affected stocks rallying. And you're going to see those growth stocks maybe pause, maybe not sell off, but you're definitely going to see them take a break whilst the airlines recover, whilst the banks recover, whilst hospitality groups recover, whilst hotels recover, because that's part and parcel of life. And when people get back to spending, those companies are going to start to see a recovery in their earnings, and therefore they're going to start to see a recovery in their share price.
If I could jump in there, if I could just jump in and say that this seems rather an odd thesis when we're all being locked down for the third time, and there may be an even enhanced lockdown here in the UK. We've taken the view that this is the sort of last one, and markets always start to discount. So the lockdowns that we're envisaging now, with the hopeful, solidity of a vaccine rollout, etc., is going to lead to the fact that when we start to emerge this time, and it might be 3 months away, it might be 4 months away, I'm not a medic, it might be 2 months away, it might be 6 months away. What we're going to be is in an uptick that allows us to gradually get back into the real world, however slowly. Now, I know people are booking 2 and 3 holidays. I mean, they're trying to book 2 and 3 holidays. They've had enough because they've been locked up for virtually, they will have been locked up by 18 months by then. So this consumption-led rally that is going to follow this could be mind-boggling. People could be out there very, very keenly driving consumption to higher levels than we've seen before. Now, it will be a surge. It will be an unusual surge, but it will lead to stronger economic growth, I think, if the COVID vaccine works for us than we're envisaging. So I think that what we will see is a bit of this and a bit of that. We'll see drive to these consumption-type led unfashionable stocks of 2020. And every now and again, people will get nervous and they'll buy a bit of high tech. It won't go away. They're solid companies. And there'll be a little more flexibility between it won't be so black and white as it's been in 2020. It'll be more subdued between the two sectors. So I think you've got this situation where the consumption towards the back end of this year could be stronger than it's ever been.
Lester, I'm going to move us on because I think we've enjoyed our market review a little too much. I think we need to catch up on some time here. I'm going to quickly touch on the next slide, which is what we need to be fearful of, right? Obviously, we've laid out that we believe there's going to be a recovery, there's going to be a good reflation of economic activity. Obviously, part and parcel of being a DFM, part and parcel of building a balanced portfolio is looking at the risks, right? So the risks that we see in 2021 on the left there is the U.S. government. You've got a Democratic House and a Democratic Senate and a Democratic President. Now, the President has some arguably left-wing policies. He does have some goals which might be slightly negative towards markets, such as tax hikes. So we believe that when you've got all three, Democrat, 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 getting tax hikes through is going to be easier, and tax hikes is going to be negative for the market, especially in the US small cap sector. So we want to make sure that we're keeping an eye out for that. The final one, the other two, that feeds onto the right-hand side as well, which is HM revenue and customs and tax, and when governments will start to tighten. The fear is that they over-tighten too quickly, and that causes a pullback in the market, because believe you me, there is a lot of money in the market at the moment, so we need to be careful of that. The middle one is a COVID variant. So if you have the vaccines now dealing with the current COVID strains, if a new one comes out that the vaccines cannot handle, that for us is a market event. So we need to make sure that we're prepared for that. We need to make sure that the portfolios have robust defenses in place to deal with that. I just want to finally touch on inflation. Inflation for us is the hidden torpedo, as it were. That could be something that really, really disrupts markets for two reasons. If you see inflation increasing, inflation is the discount measure that people use. It's the discount measure that investors use to discount future cash flows. With inflation being so low at the moment, that's one of the reasons why people have been able to buy growth stocks, is because there's such a low discount measure for future earnings, if that makes sense. So if inflation starts to increase, people's future earnings starts to decrease on the growth stocks, right? So that could be a headwind to growth rallying. Also, inflation, the way that governments combat inflation is to raise interest rates, right? So that's fiscal tightening. This market in 2020 was hooked on low rates, low inflation. If they start to raise rates too quickly, that could be a serious upset for markets. So we need to keep an eye on inflation, make sure it doesn't get away from us. What I'm going to do now is very quickly talk about Brexit. As we know, new Christmas Eve, we had a deal. It seemed to be sorted out over pizza and Eurostar. My view on Brexit, just very quickly, was that it was a skeleton deal, as many were predicting. A lot of people had already said that this was going to happen in the market. So pre-Christmas Eve, you saw a lot of the UK mid-cap sector. You saw the pound start to rally in anticipation of a deal. So when you actually had the deal on the day of Christmas Eve, the market reaction wasn't as big as people were anticipating, because a lot of that was already in the price. A lot of that was anticipated. Now, obviously, for me, being in financial services, the elephant in the room is that there was no financial services mentioned. There was very, 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 very light mention of it in the deal, which means that in terms of financial services, in terms of clients for 2021, 2022, especially European clients, there seems to be little guidance on what we can expect. So Leicester has prepared for the worst, which I'm sure Leicester can refer to.
Yeah, I think the Brexit thing for us very quickly is that markets like clarity. And whilst we in financial service have not got clarity, the rest of the UK has a fair sampling of clarity. We are now out. We know we know where we stand. And that's, I think, why you've seen a massive rally in the UK market in the last 6, 8, 10, 12 days. I know it was down yesterday, but we're seeing positive UK sentiment. And that is because clarity means a lot. Now, we're in financial services. We don't see it because there's a little bit of outstanding about passporting and our rights. But the rest of the world is seeing clarity. It's done. And that's why the UK is now seen as a bit more stable an investment proposition, I think. James.
Absolutely. I agree. I think it's a good segue into answering a question here that we've got. Do you anticipate any risk to your business if post-Brexit financial passporting is not agreed?
Well, we set up TAM Europe. We're regulated fully in Spain and passported into the rest of Europe, and therefore all of our European business has been handed over effectively to our TAM European investment operation, which is fully regulated and can deal with its European counterparts. So we're sort of covered cleanly.
I would also say from a portfolio perspective as a CIO, we have the ability to be extremely reactionary and extremely flexible with the types of models that we can create, the types of portfolios that we can construct for clients. And we've had a few European domiciled clients that have already put legislation saying we cannot have certain types of investments after Brexit. We've been very, very quick to recreate those portfolios for those clients in a compliant manner. So I do not feel concerned, even if we don't get it passporting, even if there is no equivalency, that we will be, or our clients more importantly, will be out in the cold in terms of having the best portfolio possible. We can create that. So I just want to quickly go through and talk about, well, likely reactions from the market to Brexit. We've already started to see it. You've already started to see in 2021 a reflation of UK assets. UK was the biggest geographic underperformer from developed markets in 2020. You can already start to see that turning around. The FTSE All-Share, the FTSE 100, is massively outperforming the S&P to date over the last 12 days, and we expect to see that continue. We expect to see, and I've put here a little picture of a village in Oxford, which Lester swears blind he knows where it is, but I have no idea where it is. I believe that this is for me a picture that sums up the domestic market. I believe that domestic stocks focusing on domestic revenue are going to recover nicely within 2021 if we can continue with Brexit, if we can continue to smooth things out and continue to flesh out parts of the deal. I believe it's predominantly because a lot of UK mid-cap companies have taken their foot off the gas since 2016. A lot of people have deferred hiring, they've deferred spending money on factories, spending money on output, investing in capex because they're not sure what the lay of the land is going to be. Now we have some certainty. Those companies can get back to putting money to work. This morning, there was an announcement on Bloomberg that UK IPOs, that's companies listing on the stock market, had already started to break records. That means that there were a huge tail of companies that had already come to the market, that had not come to the market because of Brexit, and they've already started to do so. So that, again, is a big shift for us. That's a big shift in sentiment. And if anything, we know that market is driven in part by sentiment, and we believe that there's going to be a good amount of sentiment moving towards that domestic end of the market.
I've been in this market too long, and when I see a UK stock market, any market being the standout underperformer in 1 year, you can sort of give it an intuitive guess that it'll be amongst one of the top 2 or 3 markets in the following year. It's just intuitive. That's what tends to happen over time. If you're really that far behind, you do an element of catching up. So the UK market looks pretty decent value, even with the Brexit problems.
And we've been positioning the portfolio to try and capture as much of that as possible. We have some very, very high quality UK mid-cap managers, Shelverton being one of them. So we've started to move capital towards that, which we're very positive about. So very quickly, that segues beautifully into how we're positioned for 2021, where we believe that assets are going to rally, where we believe the market is going to be interested in. Again, it's that reflation tacking back to 2021. It's that recovery in COVID-affected stocks. That's not to say that growth will start to sell off. That's not to say that stay-at-home stocks will start to sell off because COVID is still with us, but we believe that the money is going to be going towards the airline sectors, the hotels, the hospitality, the retail, anything that's been hammered by COVID and that is exposed to public spending. We believe that those stocks are going to be very beneficial. They are picked up within value funds. Value funds are buyers of those stocks. What we've been doing for the last 3 months is initiating positions within those funds that we believe are very high quality. Obviously, we don't want to be just piling into value. We want to make sure that we're being selective. One of the biggest things for 2021 is going to be active management, because you're going to have winners, you're going to have losers, you're going to have stocks that go nowhere, you're going to have stocks that are 10 baggers. And it's critical that you buy managers that can understand the dynamics of the market and pick their way through. One of the areas geographically that we're interested in is Asia. We believe that with Trump out of office, we believe that with Biden in office talking about US-China trade wars, that for us is a big plus for Asia. They also recovered out of COVID. I mean, they started COVID, but they recovered out of it fastest. We believe that that economy or that subset of geographic markets is well poised to capture GDP recovery. We're also playing into the theme of the rise of the middle class and millennials and consumption. As you know, Asia and including India has a middle class that is the fastest accelerating in the world. And we believe consumption is going to start to come online in swathes in 2021, 2022. So we're taking advantage of that. Oil, commodities, raw commodities, as manufacturing increases, as spending increases, as there's demand for different areas, different products starts to increase, you're going to see demand for raw materials start to spike up, especially metals. You can link that into ESG, and you can link that into electric cars, the amount of copper that's needed to create electric cars. We believe that there's going to be interest in the commodities market as well, so we've initiated positions there. And going back to what we were talking about earlier, value and growth within the UK, we believe that there's going to be a lot of focus on UK stocks. But again, active management, because COVID is still here. There will still be stocks affected by COVID, so we need to buy managers that understand the difference. But we want managers that can capitalize on that drop-off in uncertainty and the pick-up in some certainty that allows companies to get back to spending. So those are the kind of touch points in the portfolio that we're really looking to drive forwards in 2021. There are plenty of other areas that we're interested in. We've got very high quality European stocks, very high quality US stocks for what it's worth. We do have some really high quality global debt funds as well that are looking to parts of the market in terms of debt. So what we're doing first and foremost is continuing a diversified portfolio that can tailor for the best areas of the market, but also make sure that we're prepared for a rise in inflation that shakes markets too much, or any one of those factors that causes a wobble.
What I would like to say to finish this off actually is the final thing from me is that, you know, in 2020, you saw global fund managers do well because the UK was your underperforming, standout, bad market. And so you get this dichotomy between people who run their funds on a global basis, and you get people who run their funds on a UK basis with a global overlay. Now, those funds will have done a little bit poorer in the first 9 months and done much better in the last 3 months of the year. And you're going to see a big difference in 2021. Those globally minded product funds are going to underperform, in my opinion, and the UK minded with a global overlay should be doing much better. It's going to be a change in the market sentiment there. But I'll pass back to James to finish off.
So just very quickly looking at just some performance numbers for you there over 6 months, 1 year, 3 year, 5 years, start of inception, and something that Joe's very keen on, that we're very proud of, is the de facto risk rating that we've now got. And you can see that from defensive through to adventurous, which is basically the difference between defensive and adventurous is the amount of equity that it holds. Adventurous, by its name, has more equity than defensive, which has more fixed income and stable government debt. And you can see that's reflected by a de facto rating of 2. Now, you can see that we've got the start of the data numbers, the 6-month numbers, they're all positive, they're all looking very good. What I would say is, if you're interested in discussing more, because it's not good enough to just look at a small screen and understand what we do, please do get in touch with Joe. Please do get in touch with one of our salesmen or saleswomen and talk about TAM, talk about our product. Feel free to get me on a call and we can go through things in more detail.
James, I'm going to have to cut you off there because the presentation is literally about to end. I just had a notification.
Right.